This is Mark Sobel, U.S. Chair, OMFIF. Today, I'm delighted to be joined by a longtime associate, Ellen Meade, for a discussion of yesterday's FOMC outcome and U.S. monetary policy developments more generally. Ellen recently joined the economics department at Duke as research professor. Prior to that, she spent 25 years at the Federal Reserve Board. Before leaving the Fed, Ellen was a special advisor to the Fed Board of Governors and Vice Chair Richard Clarida, as well as Senior Advisor in the Division of Monetary Affairs. Welcome, Ellen. Great to have you.
Thanks, Mark. I'm thrilled to be here.
Well, good. Well, I always pretty much ask my guests the same opening up question. Was there anything about this FOMC meeting, the statement and the press conference in particular, that stood out, or was it pretty much as expected? And if you say it was as expected, I'm going to be a little surprised.
I think the changes to the statement might have been the thing that was more expected. You know, some updating in the first paragraph of economic conditions, the 25 basis point increase in the target range for the funds rate, and then that very graceful changing of the word pace to extent to describe future increases was a nice way to just shift the focus of the conversation away from how quickly they were going to where they're going to end up. I think the surprises all came in the press conference. I will confess that as I was listening to the press conference, I found it to be reasonably hawkish, but very honest. And right now there's a lot of uncertainty and a lot of waiting. This is a meeting around waiting. The March meeting is much more pivotal, I think. There'll be much more data in hand, and you get an SEP by March. But I felt the same way about the July meeting, that Chair Powell, I thought, had handled it well and honestly, and yet markets didn't react well in July, and they didn't react well yesterday. I think what I'd like to talk about first is what I heard, and then we can talk more maybe about the market reaction. You know, he did reaffirm that they're data dependent. I think he set us up to expect another 25 basis points in March, but we could get quite a bit of reformulation in the language of the statement in March, because at that point, with the 2 additional months of data in hand, they will know more about how much further they want to go before they pause. And maybe they're pausing in March, maybe they're expecting to go in May. So we don't really know that yet. I think an important point was that he acknowledged that disinflation had started. So they have seen the peak, disinflation has started, but at the same time, they have more work to do. And he did emphasize both of those. And then he did a deep dive into the data. That's something that he started at the end of November when he gave his Brookings remarks, and that I personally find, as long as it is fully reflective of the views on the committee, pretty helpful for understanding what they're looking at, right? They see goods inflation being negative. They see and are still expecting the turn in the housing data in the index that they've already seen in the real-time indicators. They don't quite know when that's going to show up, sometime around the middle of the year. What they're really focused on is this super core, you know, the core services ex housing, which he said yesterday in a bit more detail than he'd given at Brookings, 50%, 56% of core, and 7 to 8 sectors, which have differences across them, but they generally are tied to the labor market. And that then makes the linkage to wages and the labor market, where the Fed wants to see some movement there to precipitate this easing of super core inflation. I think another thing we learned is that they are expecting that goods prices, which are currently running, inflation is negative, would move back up and settle in around 0. So that could put some upward pressure on core inflation. And depending on when the timing of the housing slowing comes and the timing of that moving up in goods and the extent of both of those, you could see inflation moving back up for a bit. So I think he set us up for that. I think that depending on that timing, that could argue for them, for instance, in March going 25, if the data continue along the vein we've been seeing, they say, you know, we're in a wait and see mode and they leave you with the impression that they might not move in May. But then if they get a move up in PCE inflation again, I think they have to move in response to that. Clearly, their worry is around the persistence of this super core. I think, he didn't think the risks are balanced. The FOMC statement doesn't think the risks are balanced. He made reference to that phrase that's come up for the last 6 or 8 months of the risks of doing too little are greater than the risks of doing too much, and that history cautions against premature loosening. So I think we know where he stands on that. I think a real puzzling piece is around financial conditions. In December, he seemed to put down a big marker around financial conditions, mentioning it something like 13 times, as if that would really affect their decision in January of 25 versus 50. When he was asked about that yesterday, he didn't think financial conditions had moved much since December. He sees them higher, more tight than they were at the time they started tightening last year, which I think is not correct based on, say, the Bloomberg index. So I found that, and the markets, I think, responded to that. I thought the whole discussion around financial conditions was puzzling. And then if I could just add 2 more brief points, the markets seem to really pick up on this comment he made around pause and waiting for the minutes. So, every meeting they talk about what they see as the outlook. Of course, people would have spoken to the point of when they think they've hit the peak, when they should pause, so on, of course. And of course, we're going to see it in the minutes. I guess he felt he couldn't mention that because that would be taken as dovish. But he said what he felt he could say, and that was still taken as dovish. And I think his unwillingness to reaffirm the December dots in as forceful a way as markets were looking for was another factor.
Okay, well, we'll dig into all of that. Let me ask you about your outlook, so to speak. Inflation, there's so many statistics one can look at, and that's before you even assess whether they're annualized or 3-month annualized year over year, for example. Some are saying disinflation is happening faster than thought. Others say, well, it's one thing to get inflation down to 4, but it's another thing to get it down to 2. A lot of uncertainties around labor markets and how robust they are and what implications that has for inflation. Uncertainties about the growth outlook. Are we headed towards recession or a slow session, as I call it? And then, as you just mentioned, these debates about financial conditions that seem, to me at least, to have loosened quite a bit in recent months. What's your outlook, and how do you assess where the Fed is right now?
Well, I do think they're worried about inflation persistence. Loretta Mester mentions that frequently when she speaks. Powell seems to go there too, and pinpointing the super core measure. I think he, as I said before, I think if he has the backing of the other policymakers, then that is something they are very attentive to and will be very attentive to. And that to expect that rate of inflation to slow without some movement in the labor market is probably too hopeful. What they've written down in the SEP as a movement in the labor market that they've almost acknowledged they think will be necessary, that gets the unemployment rate a little above 4.5%. I do think the case for a soft landing has improved with the data, because the economy is slowing in a very measured way. And this is where I think maybe the financial conditions come in. If they decided to push back strongly against financial conditions, and for instance, yesterday, say, had surprised markets with 50 rather than 25, they did a surprise in June, So it's not out of their thinking. I think the problem right now is they're getting the kind of slowing in the economy that's very gradual and makes them very hopeful that they're going to see the labor market follow suit and that they can do this without too much pain. And so I think as long as the current level of conditions is delivering that, that to me is maybe one reason why he's reluctant to take that on the way he seemed to in December. Of course, we're left with the question of why did he take it on in December? And then no other policymaker, when they came out after the holidays to speak, really reacted against that. Even Governor Waller, who tends to be on the hawkish side, right, said that, if conditions continued to ease, then maybe they would have to respond to that, but he wasn't saying they had to respond now. So I think some of it is that the economy is easing, is moderating very gradually, notwithstanding, say, continuing claims this morning. The labor market is really the piece of this that I think we haven't seen as much slowing as we might anticipate, but it lags other parts of the economy. So I guess my own view would be I don't see the Fed easing materially before the end of the year. Remember that the characteristic of the SEP is that the dots are the dot on the last business day of the month, right? Unlike other things, which are the average for the fourth quarter or something, that dot is the last business day of the month. Could they ease at the December meeting? Yeah, but they're not going to want to show that in the SEP. They want to send this message that we're holding firm throughout the year. And if inflation is persistent, they probably are going to need to do that. Inflation in the super core area.
So you just said something that anticipated my next question, but the markets basically are thinking one more hike, 25 basis points. I think the chair said two more hikes at least yesterday.
Mm-hmm.
And the markets, as you suggested, are seeing rate cuts in the second half of the year, I think 2 or 3.
Mm-hmm.
The dot plot and the chair yesterday said no, unless there's a very different base case or outlook. So do you have a view on the terminal rate and how long the Fed will stay at its destination?
So I think, low fives, maybe it's 2 more. Maybe it's, if this super core is persistent, could they go 3 more? Maybe not necessarily in a row. Yeah, I could see that. I think they hold it till the end of the year, early next year. I think the SEP, though, for the reason I gave before of those dots being officially the last business day of the month, they're not going to show a cut in the SEP. So the SEP is going to show holding at that terminal rate until 24. But could they, I think it really depends on how the data turn out, right? How quickly does inflation come down, which, as Hal acknowledged yesterday, the markets seem to be thinking a lot more rapid disinflation than the Fed is. And if that happens, that's great, right? That gives them room. And it needs to be disinflation in the areas they're looking for it in, where they think wage growth has been out of keeping with 2% inflation and average productivity growth. So, could it happen? Yes. I think he was right to acknowledge that markets seem to be more optimistic. Maybe it is the right time to just say we have a difference of views. And the only place that becomes a problem is if the easing in financial conditions is an imposition or an impediment to the continued disinflation that they want to see. But we haven't gotten a hint that they're moving because of that yet, right?
Okay, well, you're opening a can of worms with that last comment. That gets us into the realm of communications and transparency. And I know this is an area where you spent a lot of time in your career working on. Well, let me just say generically, I find Fed communications extraordinarily confusing, but I'm just a simple old Treasury guy, not a monetary guru. But it seems as if every regional president has to give a speech. They all emphasize nuances, not in plain English. Markets gyrate. A lot of people said that yesterday's statement and the presser had a different emphasis at times. Forward guidance can be confusing. Either it's state contingent, or we don't want to pay attention to it. And I'll throw a curveball out there at you that you alluded to at the beginning. Markets may not react to a press conference or a statement as desired. And maybe that's an okay thing, but, presumably monetary policy also works through the markets following the desired message of the Fed. And Powell seemed to be disregarding of that yesterday. It was like, well, if the markets have a different view, that's okay, is the way I heard him. I think he said that pretty explicitly. So what do you have to tell me about Fed communications? Is it fine, or am I right to be confused? And do you have some suggestions on how to improve it?
Well, I think you're absolutely right to be confused. When I left the Fed in mid-2021, one of the things I was looking forward to was watching communications from the outside, because I'd worked on communications from the inside. But of course, the communications I'd been working on was the centralization of the messaging around the chair. The chair's message, the vice chair's messages in complement to the chair, sometimes expanding on the chair, but really not putting much room there. And we could come back to that point. But to be honest, when you're on the outside and you're listening to the range of voices and views, and even if you say, well, this person's not voting this year, or you say, I don't think Chair Powell puts as much weight on this person's views as other people, you're still left with a tremendously confusing, I think, set of perspectives. And I don't think it's getting, I don't see participants having pulled back from that over the course of the last year, where I do think messaging was very, very difficult the last year and a half. I think, in fact, they're leaning into it even more. They have many opportunities. I think short and sweet, look at Jackson Hole. Jackson Hole was tremendously effective. I just have a short statement for you today. Thank you very much. I had thought in November, the press conference might be best by reading a statement and say, that's all I have for you today, and leaving the room. I think that, back in the day when the analysis around communications and the efficiency of monetary policy was coming from a world where we had no communications. And now I think we've definitely passed the optimal point. I think Chair Powell himself seems, the more he speaks, to be interpreted as dovish for reasons that I don't fully understand. But it does seem to be related to the length of time he speaks and how much he goes away from the notebook that he carries in with him. And maybe he would be better served, because markets do pay more attention to him than anybody else, from changing that up a little bit. That would certainly get everybody's attention. If I could expand a little bit, though, he was asked yesterday about difference in views around the super core inflation, and some views that the vice chair recently put out in a speech, where she, to me, seemed to call directly into question the metric that he had laid out at Brookings, right? And said that basically there are a range of views on what it's going to take to bring down this component. And one view is the view that, it's got to involve a weakening of labor demand. So that, to me, was a little bit more of a challenge than I think a vice chair at least recent vice chairs have issued. And I think the vice chair in particular, it's important not to have too much daylight between where the chair is and the vice chair, because they work very closely together and markets can take strong signals from that.
So too much transparency.
In short, yeah.
Okay. And do you think that, I think I heard you say this, that there needs to be more consciousness of thinking through how markets are going to react when people are making their statements? Okay, you're nodding as an agreement. Well, let me ask you a question more philosophical about Fed independence. There are debates about inequality, climate, loading up the Fed's plate, putting it in a political territory. During the pandemic, some of the Fed's activities, while necessary, could be viewed as quasi-fiscal. We're racking up. We have 100% debt to GDP ratio. It's sustainable, but the outlook is not good. And when you look at the coming decades, so there are worries that about the Fed being politicized, about pressures for fiscal dominance and the like. Are you worried about the Fed's future independence?
I am a little bit, yeah. I do think that both actions the Fed has taken since the global financial crisis and changes in the world, the sort of dominance of social media and Twitter and the need to constantly be out there trying to play into a political dialogue. And I'm not just talking about the Fed. I think a lot of people are playing into a increasingly fractured political dialogue. I think that does mean that the Fed is no longer this institution that stays behind the curtain. If we go back to the pre-communications, pre-transparency times, let's go back to the 1990s, for instance. I think if you ask people about the Fed, know what the Fed was, but for the most part, thought of the Fed as this sort of technocratic, quiet, behind the scenes institution. I think the initial wave of transparency was very warranted. But now what we have, I think, is a world that's very dominated by political concerns. And in many cases, the Fed gets thrown one way or another into them, not to mention the Fed's own choice around the use of its 13.3 facilities, and especially the expansion of some of that during the pandemic, even though take-up was very low. We have to be very clear, the Fed didn't lose money and take-up was very low. It still sets a precedent. Some people have been strongly critical of the Fed Listens initiative during 2019 as part of the framework review, when the Fed went out and talked to local area businesses and nonprofits and representatives of labor and housing and so on, to assess how the broader public was seeing the dual mandate objectives. I had a central role in organizing that initiative, and I felt it was very important for the Fed to do that, and not wading into political territory. It is a central bank that doesn't just report to Congress and financial markets. It should be explaining what it does to the broad swath of Americans. And I felt like the Fed Listens was intended to do that. But there are some people out there who felt the Fed started to wade into political territory by doing that, right? Especially as it unpacked its role in achieving maximum employment. And I think this whole experience with inflation, and then Chair Powell and others going back to this sort of almost Greenspanian way of describing it, that, you need price stability as a precondition for maximum employment, almost ordering those dual mandates, I think, is something that many people haven't heard for a long time. I do think climate does present some challenges for economic management and certainly for financial stability. So I think there are a lot of issues out there that now have a sort of political thread to them, and the Fed is in there. And as you rightly say, the debt and deficits are growing, and it does raise issues around fiscal dominance, although I don't think we're there yet. But I think that whole discussion is very much invigorated. So yeah, I do have concerns.
Okay, well, let me, time is running short. Let me just throw out just one other question. The balance sheet, we didn't hear much about that. I think I read Fed research that said that something like a 2.5 trillion reduction in the balance sheet was equivalent to 50 basis points of Fed funds hiking. But the markets seem to be coming down. QT is still running quietly in the background. Do you think it's playing much of a role, and do you think it can proceed smoothly? And then since we're on the balance sheet, just the Fed just posted a deferred asset, may rack up losses this year, next, but they'll be small, I think, in comparison with the profits it's made. Anyway, some have said that the deferred asset may generate political consequences. Does this issue merit much attention at all?
Well, I think on the deferred asset, I agree with you that, if you look at the accumulated sum of profits that the Fed has returned to Treasury, the deferred asset will be small in comparison. It could, though, it's now. And for those members of Congress who are very much opposed to the kinds of asset purchasing that the Fed did, and especially I think there is debate and will continue to be a sort of retrospective looking at the amount of purchases of QE that was done during the pandemic and whether it was necessary. Not the initial purchases that were done in connection with stabilizing markets, but say after maybe April or May of 2020, or maybe even June, whether they needed to continue. And that, of course, adds to the losses now. I guess around the balance sheet, I don't see them signaling at all that they're concerned. As many have been, a little surprised that the overnight reverse repo facility remains as large as it is. In one of Lori Logan's speeches when she was still in New York, I think this one was last spring, to the money marketeers, she laid out, that they expected over time for deposit rates to rise and for the outflows to occur from ONRP and back into reserve balances, which would, of course, give them more space to reduce the balance sheet before, hitting what's called the kink in reserve demand. She was asked about that in a recent speech. They don't seem to be concerned. I wonder if by the time of the summer, those issues might be back on the table. But I think for right now, it's definitely going on in the background.
Well, great. Well, we've exhausted our time. You've been very generous to join us. So fantastic exploration of FOMC issues and yesterday's press conference and meeting. So thank you very much for joining us today.
Well, thanks for having me, Mark. It was great to talk to you.
Great. All right. Thank you.